Houston inflation is 1.2% versus US inflation today at 2.4%. Is the Fed fighting 50 different inflation battles? And how's that affect you and your portfolio? Hello, my name is Paul Carroll. I'm the CEO and founder of Avion Wealth, an elite wealth management firm based here in South Texas. So let's talk about inflation versus disinflation versus deflation. I think it's important to clarify some of the examples because there's a lot of misunderstanding about what inflation is. Prices are higher today than they were 5 years ago, and yet inflation is low. When inflation is low, it doesn't mean the prices come back down. That's called deflation. When inflation has stopped, but the prices aren't coming down, it's called disinflation. So inflation is prices rising. Gas prices go from $3 to $4. Disinflation means inflation has slowed from the 9% peak to maybe 2% today. And deflation is when prices are falling, and it's actually generally a really bad thing. We're in a disinflation phase of the economy. It peaked at 9.1% June 2022. We're currently at 2.4%, and the target for the Fed is 2%. But what's interesting today are the regional inflation disparities. Texas, and Texas cities in particular, are experiencing about 1.2 to 1.4% inflation. Florida, Tampa is about 2.6. California in the Northeast is 3 to 4% inflation. Why is Texas so low? Well, there's a number of drivers. There's no state income tax in Texas or Florida. There are much lower housing costs, partly because it's so much easier to build. Energy production, not just oil, but gas, and also alternative energies, mean that energy is plentiful in Texas. And population inflows are increasing the supply of labor, so those states losing labor are seeing labor costs go up, while we're seeing labor costs moderate. Right now, about 1,000 people a day are moving to Texas. So these divergent inflation rates, plus the national inflation rate of 2.4, creates quite the headache for the Fed. Right now, the Fed funds rate is 4.25% to 4.5%. It last changed in December 2024. And the markets are anticipating 2 interest rate cuts throughout the rest of the year. There's a dilemma the Fed's dealing with. The first part is tariffs threaten higher inflation. Now, there's a lot of noise today going, well, we've got the tariffs and inflation's not here. Tariff inflation takes about 3 to 4 months at least before it feeds through the entire supply chain. The economy is showing significant resilience, as 4.2% unemployment is statistically considered full employment. But regional disparities are significantly complicating policy. The European Union actually faces the same problem. When Germany and France are doing well, but Greece and Spain are hurting, the same policy does not fit all. Right now, the policy, as succinctly put by Powell, is we don't have to be in a hurry. Interest rates can stay put in the interim. So when we look at the United States, we're actually looking at regional economies. California alone is the 4th largest economy on the planet. It's extraordinary. Texas isn't far behind. So interest rates where they are today hurt California in a number of ways. First, California is seeing accelerating tech layoffs. A lot of people like to say it's because of AI. It's a little early in AI's story for it to be mostly about AI, and this has been going on a little bit already. Same is true with Austin. Commercial real estate is being badly hurt by higher interest rates. And a lot of the regional banks in California are being hurt by some of the reserve requirements being imposed. The low inflation winners, we've got Texas energy sector, we've got Florida with its tourism and services, and we've got the Sun Belt with their manufacturing. This has led to what's called a K-shaped recovery. Certain parts of the country are doing really well. Other parts of the country are still dealing with aggressive inflation. And so to further complicate, we've got questions about what is even the correct measure. So currently, we have CPI of 2.4% year over year. The Fed actually prefers to use what's called the Personal Consumption Expenditure Index, which is considered more accurate. But the core PCE rate is actually 2.6%. Usually it's lower. Regionally, however, we're seeing PCE range from 1.2% all the way to in excess of 4%. So the reality check is these different regional disparities affect us as investors. They affect us as people living on a fixed income. In the next video, we're going to talk about what happens when $36 trillion of debt hits higher interest rates. And that's before the big, beautiful bill. If this or any of this is affecting you, or you want to know more about how this is likely going to affect the deficit, inflation, taxes in your portfolio, please feel free to reach out. We'll talk about it together. We wish you the best of investing success. Thank you.